If you're a business owner, September 15th probably makes you a little sick to your stomach. That's the day you write a check to the IRS for taxes on money you might not even have made yet. And here's the thing, most people are paying way more than they need to, and a lot of them are paying at the wrong times and the wrong amounts for no reason other than nobody ever showed them a better way. Every September, I watch business owners drain cash out of healthy companies simply because nobody showed them the rules. Hey there, I'm Tiffany Phillips, CPA and tax strategist. Today, I'm walking you through exactly how to shrink that September 15th check legally using the exact tax planning strategies that have saved my clients thousands of dollars. Let's start with why this deadline even exists, because a lot of business owners think of it as just an arbitrary IRS headache. It's not. The US tax system runs on a pay-as-you-go basis. When you're a W-2 employee, your employer withholds tax from every paycheck automatically. But when you're a business owner, nobody's withholding anything for you. The IRS wants its money 4 times a year in April, June, September, and January instead of waiting for you to settle up on tax day. Miss those payments or underpay by too much, and you're not just writing a bigger check later, you're also paying a penalty on top of it, calculated like interest for every quarter you were underpaid. Now, here's a fun fact. There's a rule most business owners have never heard of that can take a huge amount of pressure off this whole process. It's called the safe harbor rule. Here's how it works. If you pay in through withholding and estimated payments combined, at least 100% of what your total tax bill was last year, the IRS can't penalize you, even if you end up owing a lot more this year. If your income was over $150,000 last year, that threshold goes up to 110% instead of 100%. Now, I want to be really clear about something because this trips people up constantly. Safe harbor protects you from underpayment penalties. It does not eliminate the tax you'll ultimately owe. You'll still settle up the full amount when you file. Safe harbor just makes sure the IRS can't charge you a penalty for how you paid throughout the year. Let me give you a real world example. I had a client, Chris, who ran a contracting business. His income tends to swing wildly year to year depending on which big jobs land when. One year he had a huge spike and he panicked, assuming he needed to send in estimated payments based on that spike continuing. He didn't. We calculated his safe harbor number off the prior year's actual tax bill, paid exactly that amount across his 4 quarters, and he was completely protected from penalties, even though his actual tax liability for the year ended up being almost double what he paid in. That's the difference between guessing what you owe and knowing the exact minimum number that keeps you penalty free. But here's where CPAs tend to stop and where I think the real strategy actually starts. If you're taxed as an S corporation and you're paying yourself a salary, you have a tool most sole proprietors don't. Here's the crazy part. For federal income tax withholding, the IRS generally treats wage withholding as though it was paid evenly throughout the year, even if you withhold an extra $15,000 from a single paycheck in December. That's one of the least understood rules in the tax code, and it means if you're behind on estimated payments in September, you can catch up entirely in November or December, and the penalty clock resets as if it never happened. This is where tax planning becomes strategy instead of bookkeeping. Here's another example. Robin owns a hiring agency, and she had a genuinely great year. Revenue was up, but she hadn't adjusted her estimated payments to match. By September, she was staring at a real shortfall. Instead of scrambling to wire the IRS a massive lump sum with penalty exposure hanging over her head, we increased her S Corp salary withholding for her final 2 paychecks of the year. That withholding covered the gap completely, and because it's treated as paid evenly across the year, there was no penalty at all. This isn't theory, it's exactly how the IRS rules work. If you want me to walk through exactly how to calculate the right withholding adjustment for your S Corp, comment withhold, tell me whether you're an S Corp, an LLC, or a sole proprietor, and I'll know exactly which strategy applies to you. There's one more mistake I see constantly, and it's this. A lot of business owners just take last year's tax bill, divide it by 4, and send in the same amount every single quarter, even when their income isn't flat throughout the year. If your business is seasonal, or if you had a slow first half and a strong second half, that even split can mean you're massively overpaying early in the year and starving your own cash flow for no reason. Let me stop for a second here because this one surprises people. Imagine 2 businesses. One earns money evenly across the whole year. The other earns 80% of its money in summer. Why should they pay their quarterly taxes exactly the same way? They shouldn't, and the IRS actually agrees. There's a method built specifically for this called the Annualized Income Installment Method, and it lets you calculate each quarterly payment based on what you actually earned during that specific period instead of a flat guess. Let me show you exactly what that looks like with a client of mine, Danielle. Danielle runs a landscaping and hardscaping business, and her income is almost the definition of lumpy. The first quarter of the year, January through March, she's barely breaking even. Snow removal covers her costs, but there's very little profit. Then spring hits, and by the second and third quarters, she's running at full capacity, booked out weeks in advance, and that's where almost all of her annual profit actually gets made. Under the old flat split method, Danielle's accountant had her paying the exact same estimated amount every quarter, a quarter of last year's tax bill 4 times. That meant every April she was writing a check for a quarter of the year's total tax bill during her slowest, leanest months based on income she hadn't come close to earning yet that year. She was borrowing money to pay taxes on income she hadn't earned yet, and then sitting on cash by Q4 that she'd already overpaid months earlier. So we moved her to the Annualized Income Installment Method. Instead of a flat quarter each time, we calculated what she'd actually earned in each specific period and based her payment on that. Her Q1 payment dropped by more than half because her real Q1 income was a small fraction of her full year total. That freed up real cash during the exact months she needed it most for payroll and equipment costs before the season ramped up. Her Q3 payment, on the other hand, went up because that's genuinely when her income was landing. Same total tax bill for the year, completely different cash flow experience, because the payments actually matched when the money came in. That's the entire point of this method. It's more paperwork, I won't pretend otherwise, but it's not a loophole and it's not aggressive. It's simply telling the IRS the truth about when your income actually happened instead of pretending it happened evenly across 12 months when it didn't. Now here's a deduction that's going to blow your mind if this is the first time you're hearing about it. Before that September 15th deadline hits, you still have time to make moves that directly reduce the tax bill you're calculating the payment against, not just delay when you pay it. Let me make this concrete with numbers, because vague advice like fund your retirement account doesn't mean anything until you see it applied. Say you're projecting $40,000 in Q3 estimated taxes based on your income so far this year. If you're eligible to make retirement plan contributions this year, coordinate those decisions with your CPA before calculating your estimated payments, because contributing $18,000 to a solo 401k, for example, may reduce the income you're paying estimates against. Depending on your bracket, that single move could shrink what you owe by several $1,000s, and it's money that's still yours, sitting in a retirement account, not gone. Same logic applies to equipment you were already planning to buy. If you know you need a new truck or a piece of machinery in the next few months anyway, placing it in service before year end, when appropriate, can pull that deduction into this year's calculation instead of next year's. You're not spending money you weren't already going to spend. You're just being intentional about when the deduction lands. And this is exactly the kind of decision worth running by your CPA before you lock in a number. If you are not looking at these levers before you calculate your Q3 payment, you're calculating a check based on a bigger number than you actually need to. So here's how this comes together. First, calculate your safe harbor number off last year's actual tax bill so you know the floor that keeps you penalty free. Remembering that safe harbor protects you from penalties, not from the tax itself. Second, if your income is lumpy like Danielle's, look at the annualized method instead of a flat quarterly split. Third, if you're an S Corp owner, remember that withholding is your safety net. You can adjust it later in the year and it still counts as if it was paid all along. And fourth, coordinate with your CPA or tax strategist on moves like retirement contributions or equipment timing that can lower the actual tax bill itself, not just delay it. This is why you don't just pay estimated taxes. You design your estimated tax strategy around how your business actually makes money so that it doesn't have to hurt at the worst time. The IRS isn't asking you to overpay. They're asking you to pay correctly. There's a huge difference, and understanding that difference can leave thousands more dollars inside your business. If you want help figuring out your specific safe harbor number or your S Corp withholding adjustment, comment withhold and tell me whether you're taxed as an S Corp, an LLC, or a sole proprietor. And if you really want to understand how your biggest expense affects your wealth, grab my book, Your Biggest Expense. It's linked in the description and it's enlightening. And if you would, take a minute to share this content with someone who you think might need it. The more this content is shared, the more people it can reach. And it's my goal to get the word out to help everyone legally keep more of their own hard-earned money. Thanks for being here. Remember, it's not what you make, it's what you keep. So keep more.